Somewhere in America, an office tower just failed its refinance. Not because the tenants left overnight, but because the math that built modern commercial real estate has quietly broken. For a long time, commercial real estate was the safe asset class. Office towers, shopping centers, and warehouses quietly threw off rent backed by cheap debt. Then the world stopped going to the office. Remote and hybrid work hollowed out downtowns that were built on 5-day commutes. By 2025, U.S. office vacancy had pushed toward record levels, flirting with the high teens nationally and far worse in some tech-heavy markets. As 2026 begins, that line isn't snapping back. It's plateauing near those extremes. Behind that simple chart is a blunt reality. A big slice of America's office space is no longer needed at the prices owners thought it was worth. High vacancy alone doesn't break the system. What breaks it is when the debt comes due. Between 2024 and 2028, roughly $2.8 trillion in commercial mortgages will mature. A large share of that piles up in the middle years, with maturities rising into 2026 and peaking around 2027. Most of these loans were written when base rates were near zero and borrowers could finance at 3 or 4%. Rolling that same debt today often means something closer to 6 or 7%. At the same time, valuations are under pressure from higher cap rates and persistent vacancy. That combination is the refinancing wall. Each bar on this chart is thousands of buildings that will either refinance, restructure, or be forced to change hands. If you only look at the biggest banks, this doesn't look catastrophic. For institutions with more than $100 billion in assets, commercial real estate loans are only around the low teens % of total lending. But small and regional banks, the ones that finance local offices, strip centers, and apartments, are much more exposed. For community-sized banks, CRE loans can reach on the order of 40 to 50% of total loans, roughly 3 to 5 times the concentration of the largest banks. So when a building can't refinance or has to be marked down, the first real damage shows up on the balance sheets of local lenders, not Wall Street megabanks. Regulators watch this closely because once CRE exposure climbs to several times a bank's capital, it becomes a potential red flag for future losses and tighter credit. Commercial real estate isn't dying, it's splitting. Older, commodity offices in weak locations are being exposed as economically obsolete. Many will end up discounted, converted, or demolished. At the same time, top-tier trophy offices, logistics warehouses, data centers, and necessity retail are holding up far better. Demand is concentrating in fewer, better assets, while the long tail of mediocre buildings quietly erodes in value. For investors, that's the key shift. The headline vacancy rate is only the starting point. The real question is which side of this split your capital is sitting on. The coming years won't look like one big crash. They'll look like a long, drawn-out audit of every building financed in the era of free money, and every bank that holds the debt. If you want more data-driven breakdowns of how credit, real estate, and banks intersect, consider subscribing. I'm Marcus. See you in the next one.